Shil bhai, there is some issue with the streaming something. They are checking it. It's not configuring, the stream key and URL वहाँ पे slide के end पे एक बारी
Okay.
we have to wait little.
Okay. No, should we wait or should we postpone the live stream?
If there's a time we can wait, like I mean, if you are if we do have 5-10 minutes, like I mean, we can wait.
नहीं, 5-10 मिनट में तो फिर लिंक एक्सपायर हो जाएगा.
I'll let you know.
Basant sir, it might just take some time. There's some technical issue which the team is trying to figure it out.
No problem at all.
Yeah.
Just give me. Shil bhai, it will take 2 minutes. हम लोग stream की key को change कर रहे हैं. Please give us 2 minutes.
Sure. 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 No worries.
Shilpi, we are ready, but just give me just few seconds. We are giving it.
Okay. Hello and welcome to ET Markets Smart Talk. Well, I'm your host, Shatajananda, and with the union budget laying strong emphasis on fiscal discipline, capex push, and reforms in the bond market, fixed income investors are closely watching what this means for yields, borrowing, as well as debt fund strategies. Well, to decode this themes, we are joined today by Basan Bafna, who's head fixed income Mirai Asset Investment Managers India Limited. Basan, thank you for joining us today on ET Market Smart Talk.
Thank you for having me over.
Thank you so much for taking the time out, Basan. And you've called this budget continuity with physical prudence. What were the key signals that reassured you about the government's commitment to fiscal consolidation?
So, firstly, it's the track record of the government. I mean, over the last decade, barring COVID times, which were an exception, the track record has been towards fiscal prudence. And if you look
Okay.
at the underlying dynamics, I think the revenue targets seem extremely reasonable. And the other bit is that, with rupee being depreciative bias, uh, it opens up a lot of buffer for RBI to look at an additional amount of dividend to be able to support the government's budget targets. While the disinvestment target is a bit higher as compared to previous years,
Mm.
but I think the pipeline is quite robust, and I think a couple of them are at the final stages of negotiation. So it looks reasonable, but I think that's one point that we need to look out for. But in general, I think the numbers look quite credible.
Absolutely. And net borrowing was also broadly in line with expectations. How important is this number for bond market and yields in the near term, Basan?
So, couple of things here. One is, while net borrowing was broadly in line with expectations, but I mean, the gross borrowing, of course, with high amount of redemptions, the gross borrowing number was expected at around 17.2, but markets expected a couple of things. One was that, given that the government had done a series of buybacks in the previous year,
Right.
making the borrowing number lower, there was an inherent expectation built up within the numbers that there would be a lower gross borrowing number in view of buybacks, as well
Okay.
as some amount of switches. But this time, what has happened is that the government has looked at switches with near maturity beyond FY27, and
Mm.
therefore that's not been built in into the numbers of this year. But
Okay.
I mean, once you start seeing fiscal space opening up within the budget parameters during the year, I think
Right.
that's not a closed door. You might see some sort of buybacks or switches
Mm.
coming in into the year. In terms of bond market spreads, I mean, the numbers are extremely attractive as compared to historical spreads. So if you look at the 10-year
Mm.
benchmark government bond yields, they are trading right now as compared, at around 145 basis points over repo rate.
Right.
Historical year median is closer to 105 basis points. So from that
Mm.
perspective, it looks quite attractive, especially in the background of the fact that we are looking at a stable inflation regime.
Absolutely. And the government has also sort of reiterated its goal of bringing the debt to GDP ratio to around 50% by FY31 from the current, I think it's around about close to more than 55% right now. So, from a fixed income perspective, how critical is this target for India's long term borrowing costs?
So I think we are at an inflection point wherein foreign investors have started looking at us. So we've had a couple of index inclusions already, and
Mm.
a couple of others are looking at it. One is very closely looking at it. Uh, the other bit is that from a ratings perspective, we've had an upgrade from one of the global rating agencies. Two other rating agencies are looking at us. So from that perspective, it's important to have fiscal consolidation in place and a future fiscal consolidation path. So from both of these perspective, it is important because as a percentage of our overall borrowings, we are still very low in terms of foreign investor participation vis-a-vis other countries who are peers to us. So from that perspective, there is a huge scope that is still available for investor participation to be undertaken. And from that perspective, it is important to have fiscal consolidation roadmap as well as year-on-year track record of fiscal path being met.
Absolutely. And the budget also announced a market making framework for corporate bonds. How significant is this step in improving liquidity in India's corporate bond market?
It's extremely important. So if you look at how equity has got built, I mean, it's broadly the retail that has been able to participate, but because the bond market is broadly not sort of for small sizes, it is important for market making to be available to retail investors so that there is price transparency for them. And once that happens, so for example, if you look at 1 year, say, corporate bonds, they are trading at closer to 100 basis points over and above traditional fixed income instruments like fixed deposits with a similar rating profile. So from that perspective, it provides an additional avenue as and when the opportunity arises. But once market making starts, the investor gets one liquidity availability as and when he requires that money to sort of come back to him. And the second and more important is that, along with liquidity, he will be able to capture capital gains as well. So right now spreads are quite attractive as compared to historical trends. And as and when yields start reversing and going towards long-term averages, then you will have the opportunity to book capital gains as well.
Absolutely. And there was another thing mentioned about the total return swaps as well. So what role will TRS or total return swaps play in deepening the corporate bond market, especially for the institutional investors, Vasant?
So this, I think, perhaps is a follow-up to allowing corporate bonds as a part of HTM books for banks. So if you recollect, banks were allowed to buy corporate bonds in their HTM books, which essentially means that then these are not mark to marketed. Now, given that you are allowed to buy corporate bonds, we've seen over the last year a lot of banks having participation in the corporate bond markets very actively. A lot of new banks have come in. A lot of existing banks who were looking at corporate bonds have increased their sizes of corporate bond participation. Now, with TRS, what happens is that you have the ability to raise money against that by way of a floating rate instrument, by looking at a swap and on a back-to-back hedged basis. And given that we are, as a country, we have moved towards EBLR, external benchmark rates, then this gives you a good ALM match to be able to lend against it. So over the medium term, I think this has a very good potential. While in sovereign instruments, we already have this, but having this in corporate bonds would go a very far way in deepening the markets.
Absolutely. And from a portfolio strategy perspective, Vasant, how should sort of debt investors position themselves after this budget in terms of duration and credit exposure?
So in terms of the curve, as against, say, 6 months back, the curve has flattened significantly. So the tenor premium is not very significant to be able to take longer sort of durations right now. But the shorter end of the curve is extremely attractive. So just to give you a reference, back in March, when we were in liquidity deficit, you just started the rate cut cycle. Rate cut had happened. Repo rate was close to 6.25%. Overnight rates were close to 6.5%. At that point of time, also, I think 1 year bank borrowing rates by way of certificate of deposits had peaked at close to 7.6, 7.65 sort of levels. Today we are in liquidity surplus. Overnight rates are significantly below repo rates, and with that also you have 1 year borrowing levels at close to 7%, which essentially means that even if you not look at overnight rates, just the repo rate, be conservative, you are still at spreads of close to 175 basis points as against March levels, wherein you were at liquidity deficit and you were still at close to 110 basis points. So from that perspective, given that the curve has become extremely flat, we like the 1 to 3 year part of the curve the most, in terms of providing an alternate to conventional instruments, as well as provide possibility of significant amount of cap gains. But having said that, I mean, the entire curve up to 3 years looks extremely attractive, so investors should look at their investment horizon and then decide the allocation. So if you are having an investment horizon which is like, let's say for example 3 months to 6 months, you should look at say a 6 month sort of a product. If you have an investment horizon of say 6 months to 1 year, then you look at a 1 year sort of a product. While YTMs or yields on these instruments may be close to similar, given that the curve is extremely flat. But from a risk reward perspective, it's a good strategy to sort of increase a bit of duration from here.
Okay, perfect. And finally, is there any specific segment of the bond market, be it GSEC or SDL or probably the corporate bonds, that looks more attractive after these announcements?
Yeah, so as I mentioned, corporate bonds up to 3 years look extremely attractive. And certificate of deposits also look quite attractive, right up to 1 year. Government securities as well, if you look at the 3 year government security, 5 year government security, and 10 year government security, so 3x5 right now is close to 60 basis points, whereas 5x10 is still, closer to 25 basis points. So from a attractiveness perspective, we like the 5 year part of the curve the most. But from a tactical play, one could also look at 10 year part of the curve. We would like to track the SDL calendar very closely, given that most of the announcements that have been made over the past year, 70% of that is being borne by states. So we would, and the long only investor demand in this segment has been quite muted over the last year, given change in equity regulations for these entities, allowing them to increase their allocations from 15% to 25%. So overall, long bond demand from these investors have absolutely muted, because of which the burden has fallen to the rest of the participants. So over the last year, we've seen that these sort of entities have increased allocations to equity, but I think they are closer to full now, in the range of 22 to 24%, which essentially means that over the year, you should start seeing demand emerging from these entities again. But we would like to first see the signs of that, as well as the underlying duration of the SDL calendar, before taking that call. But having said that, the spreads look extremely attractive. So if you go back in March, you had spreads of SDL versus GSEC at close to 40 basis points. We are at close to 75 basis points today. So it's very, very attractive. But at the same time, we would want to closely track the demand versus supply dynamics to take a call there.
Absolutely. Well, on that note, thank you so much, Basant, for sharing those insights. In fact, to sum up, this budget appears to strike a balance between fiscal discipline and growth, while also pushing important reforms to deepen India's corporate bond market. We appreciate you taking the time out, Basant, to break down what this budget means for fixed income and debt fund strategies. Thank you so much for taking the time out there.
Thank you, Kshitij, for having me over.